Technical analysis. Technical analysis is an indicator used to evaluate investment and identify trade by analyzing the statistical trend collected from trading activities. In this slide, we will explain to you about stochastic oscillator, MACD, RSI, Henke-Enshi, and parabolic SAR. The first one, stochastic oscillator. Stochastic oscillator is a momentum indicator developed in 1950 by Josh Lane. Stochastic give indication of overbought and oversold, entry, trading, and divergence. The value of stochastic oscillator is bounded from 0 to 100. This indicator shows the momentum by two lines, blue line and red line. The blue line represents the K, which is the stochastic, and the red line represents the default moving average. Overbought and oversold. Overbought is a zone where a stock is at an overbought level. The region of overbought is over than 80. Oversold is a zone where a stock is at an oversold level. The region of oversold is below than 20. This is an example of overbought and oversold in the 20 and 80 region. Entry trading. Stochastic can give signal to buy and to sell. When the blue line crosses over the red line, it's a buying signal. The cross line of blue over the red line on oversold region, this changing is called golden signal. When the red line crosses over the blue line, it's a sell signal. The cross line of red over the blue line on the overbought region, this changing is called the signal. This is example of the trading entry by the two lines cross over each other. Divergence. Divergence is an area where it's a contrast trend between the price movement and the stochastic indicator. The divergence gives signal that where the trend will be show the reversal. If the price trend bullish and the stochastic show the contrary, it's a signal that the price will move higher. And if the price trend is bearish and the stochastic show the other side, it's a signal that the price will be moved lower. This is an example of divergence. We can see the difference between the price movement and the stochastic on the below.
MACD stands for Moving Average Convergence Divergence, developed by Gerald Apple in the late 1970s as a tool that utilizes moving average to determine the momentum of an asset's ability to calculate and indicate rapid short-term momentum increases or decreases. Before diving into the mechanism of MACD, it is essential to understand the concept of moving average. A moving average is simply a line that represents the average value of previous data during a predefined period. Can be divided into two different types, which are simple moving average, also known as SMA, and exponential moving average, also known as EMA. While the SMA assigns equal weight to all previous data, and EMA assigns more importance to the most recent data values. For the MACD indicators consists three elements moving above and below the central line, which are the MACD line, signal line, and the histogram. The MACD line helps determine up or downward momentum by measuring the gap between two EMA. The signal line is usually a 9-period EMA of the MACD line. That is a 9-day EMA on daily charts and can be a 9 hours EMA on hourly charts. The MACD histogram is a graphical representation that is calculated based on the differences between the other two lines. Instead adding the third moving line, the histogram is made of bar graph, making it visually easier to read and interpret. As the name suggests, the moving average convergence divergence track the relationship between moving average and the correlation between the two lines can be described as either convergence or divergence. Convergence when the lines gravitate toward one another, and divergence when they move apart. Crossover, which is happen when line crosses above or below the central line or above or below signal line. The both center line and signal line crossover may happen multiple times, producing any false and tricky signal, especially in regards to volatile assets.
Next, Relative Strength Index. RSI is a momentum oscillator developed by J. Wallace Wider, which measures the speed and velocity of price movement of trading instruments over a specific period of time. The objective of RSI indicator is to measure the change in price momentum. RSI can be used to spot a general trend. It is considered overbought when it goes above 70 and oversold when it goes below 30. 30 until 70 region of RSI is considered to be normal zone. The calculation of RSI. The formula for calculating RSI is as follows. RSI equals to 100 minus 100 divided by 1 plus RS. Example of RSI. As if you guys can see, it will become overbought when it above 70 and it will become oversold when it below 30.
Heikin Ashi. The Heikin Ashi is a Japanese candlestick-based technical trading tool that uses candlestick charts to represent and visualize market price data. It is used to identify market trend signals and predict price movements. The Heikin Ashi method uses average price data that helps filter out market noise. The absence of market noise produces a clear picture of market trends and directions that help determine potential price movements. Trading techniques help traders in identifying when they should hold a trade, stop a trade, or identify if a reversal will occur. Traders are able to adjust their positions accordingly, i.e., either avoid losses or lock in profits on the selected position. Ashi indicator signals. The Heikin Ashi technique reflects the trend prevailing in the market through indicator signals. There are two main aspects of the Heikin Ashi indicator signals: 1. Trend strength, 2. Trend reversal. Trend strength. The first aspect is measuring the strength of the trend. Small consolidations and corrections may not be visible on the chart due to the smoothing effect of the indicator. Hence, in order to trade in the trend with the Heikin Ashi technique, it is advisable to use a trailing stop to widen the rewards of trading within the trend. It is recommended that a trader should stay in the trend to profit from it if the trend is strong. Below are the different kinds of trends for Heikin Ashi. 1. Bullish trend. A strong signal for an uptrend shown by the presence of a lot of consecutive green candlesticks without lower shadows. 2. Bearish trend. A strong downtrend signal is shown by a lot of consecutive red candlesticks without upper wicks. 3. Triangles. There are three types of Heikin Ashi triangles, being ascending, descending, and symmetrical ones. If the indicator breaks above the upper boundary of a symmetrical or ascending triangle, it's very likely that the uptrend will persist. If candles drop below the bottom line of the descending triangle, the bearish trend will continue and strengthen. Trend reversal. Trend reversal signals help in determining the time to exit a trade according to the previous trend and enter a new trend. By identifying reversal signals, traders can avoid losses by entering new trades instead. Doji candlestick. A candlestick with a small body and long shadows. It always signals the presence of market uncertainties. When it comes to the Heikin Ashi, it signals a trend reversal. There are two types of wedges, up and down wedges. The wedge also somewhat resembles a triangle. The rising wedge indicator requires traders to wait until the candlestick breaks below the indicator's bottom line. If there is a price decline, traders should wait for the price to break above the top line, and the downtrend will change. Heikin Ashi strategies. 1. The emergence of a strong bullish or bearish trend. This is the most common strategy for the Heikin Ashi technique example to identify the beginning of a strong uptrend or downward trend. Signal indicators of Heikin Ashi are normally considered very reliable and are rarely wrong. Hence, traders can ride the trend profitably due to the credibility of the Heikin Ashi trend signal. With the emergence of a bullish trend, traders with short positions may exit while those with long positions should increase and consolidate their positions. 2. Identify candlesticks with no shadows. Identifying candlesticks with no shadows is a very credible signal that a strong bullish trend is starting. This strategy is one of the prime Heikin Ashi strategies because of its record performance and success rate. The greater the sequence of candlesticks with no tails, the stronger the expected trend will be. Equally so, identifying candlesticks with no upper shadows, traders should expect a new stable downward bearish trend to continue. 3. Candlesticks with small bodies indicate trend pauses or reversals. The emergence of candles with small bodies are signals traders should be aware of and take notice. These candles are used to signal when a trend is about to pause or reverse. Hence, when traders notice this, they move to open new positions in response to an ending trend. However, traders should be cautious as the trend might be pausing and not necessarily reversing. In that case, skill is required on the part of the trader to determine if it is really a reversal coming or just a trend pause. Benefits of the Heikin Ashi. 1. Accessibility. Heikin Ashi is one of the most accessible indicators that does not require any installation and can be found on any trading platform. 2. Filtering of market noise. The indicator filters out market noise and reduces small corrections, making the signals more transparent. The smoothing effect makes it easier for trend identification. Markets are full of noise nowadays. Hence, with the help of noise reduction, the Heikin Ashi technique helps traders plan their entry and exit points more efficiently. 3. High chart readability. It is easy to interpret as any trader is able to read the candlestick patterns. Heikin Ashi candlesticks are better deciphered than traditional candlestick charts, hence it's easier to identify market trends and movements. 4. Ability to combine with other indicators. The Heikin Ashi indicator can be combined with other technical indicators to give even stronger signals on market movement. 5. Reliability. Heikin Ashi is a very reliable indicator, providing accurate results. It uses historical data, which is also quite dependable. 6. Time frame tolerant. The technique can be used on any time frame from hourly, daily, monthly, etc. However, bigger time frames are more reliable. Limitations of the Heikin Ashi technique. 1. Time gap. The use of historical prices where the base signals of the Heikin-Ashi indicator are based on means that there is a time lag involved. 2. Lack of price gaps. Most traders use price gaps to analyze price momentum, trigger entries, or position stop-loss orders. Although Heikin-Ashi lacks price gaps, traders can counter such a limitation during a trading session by switching temporarily to traditional candlesticks. 3. No full price information. Heikin-Ashi data is averaged, hence, it does not show actual open and close prices. This may not work well for day traders or scalpers with more active securities.
The parabolic SAR is typically depicted in an asset chart as a series of dots near the price bar. Where these dots are above the price, it usually indicates a downward trend and is regarded as a sell signal. As the dots shift below the price, it indicates that the asset direction is upward and that it's time to buy. For example, we can see that some dots are appeared in chart. So from that dots, we know when the best time to buy and sell the asset. The parabolic SAR is typically depicted in an asset chart as a series of dots near the price bar. Where these dots are above the price, it usually indicates a downward trend and is regarded as a sell signal. As the dots shift below the price, it indicates that the asset direction is upward and that it's time to buy. For example, we can see that some dots are appeared in chart. So from that dots, we know when the best time to buy and sell the asset. How to calculate SAR? The parabolic SAR uses the highest and lowest price as well as the acceleration factor to determine where the SAR indicator dot will be displayed. The formula for the parabolic SAR is as follows. Uptrend parabolic SAR equal to prior SAR plus prior AF, which is prior EP minus prior SAR. For downtrend parabolic SAR equal to prior SAR minus prior AF, which is prior SAR minus prior EP. That's all from us. Thank you.